Last video, I said something that I think is worth repeating. A preferred return tells you who gets paid first. It doesn't tell you how much you'll actually make. And I ended by saying the pref is just one piece. It sits inside a bigger structure. That structure is called the waterfall. Now, most people hear waterfall and think it's some just legal term that only lawyers use and attorneys care about. But here's the reality. The waterfall might be the single most important thing in any deal that you actually look at. It's where all the incentives live, and most investors do not put enough time into viewing this. A waterfall is just the order in which money comes back to you. That's it. Think of it this way. A deal makes money. That money has to go somewhere. The waterfall tells you who gets paid, in what order, and how much. In most deals, there's a version of the same basic flow of capital. First, you receive your preferred return as an investor, the priority recovered last time. That's the hurdle. The sponsor doesn't participate until that hurdle has been met. Then you get your capital back, your original investment, dollar for dollar. After that, the sponsor starts to participate, usually through a catch-up followed by a profit-sharing split. That's the rough outline. Pref, capital back, catch-up, split. Now, I should mention, you'll sometimes see things sequenced differently. Some deals return capital before pref, some blend them all together, but in most of the private equity and real estate structures I see, the pref is paid first. And that's the version I'm going to walk you through here today. Simple enough, but the skeleton doesn't tell you much. It's the variations of that skeleton that outline that determine your actual experience as an investor. And those variations, that's where things get really interesting. Now, here's where it gets practical. The outline I just described, pref, capital back, catch up, split, shows up across most private deals, but it looks and feels very different depending on the type of deal that you're in. And this matters because most investors evaluate every waterfall the exact same way. They shouldn't. Real estate. In most real estate deals, the waterfall is tied to two things: ongoing cash flow from the property and then the eventual exit and sale. So you might get monthly or quarterly distributions while you own the asset. That's your pref being paid current. Then when the property sells, the remaining waterfall plays out. Capital back, catch up, split. The thing to pay attention to real estate is how you're getting paid during the hold versus what happens to the exit. Some sponsors take a promote on cash flow along the way. Others only take it at the back end. This changes your experience dramatically. Even if the headline terms look the same, let me give you a quick example. Say you're in a multifamily deal. The property cash flows around 6% during the hold period, but the pref is 8%. So the 6% covers most of your pref, but not all of it. The remaining 2% accrues. It builds up on paper while you're getting your quarterly checks. When the property eventually sells, the accrued balance has to be settled prior to anything else moving through the waterfall. A lot of investors don't realize that part of their pref has been accumulating the entire time. They see the quarterly distributions, assume they're getting their full 8%. They're not. They're getting 6%. And the rest is a promise tied to the exit. Private equity. Private equity waterfalls tend to be simpler in one sense. There's usually no cash flow during the hold period. You're buying a company, growing it, and the intention there is to go sell it. The waterfall really plays out at the exit. But the complexity shows up oftentimes in the fund structure. You're not in one deal. You're in a fund that makes 10, 15, 20 investments. And the big question becomes, is the sponsor's carry calculated on cash, on an individual deal, or across the entire fund? That distinction alone can swing your returns more than you think. We'll get to that in a future video. Private credit. Credit waterfalls are the most straightforward overall. You're lending money. The return is mostly interest income paid on a specific schedule. The waterfall here is less about profit splits and more about the priority of repayment. If something goes wrong, who gets paid first? Senior, mezzanine, equity, your position in the capital stack is crucial when looking at the waterfall. Same word, waterfall, but very different mechanics depending on what it is that you're investing in. You can't evaluate a deal by the top line terms. An 8% pref in a real estate deal is not the same as 8% pref in a private equity deal. And neither of those are the same as an 8% yield in credit. Three different structures, three different risk profiles. The waterfall is where those differences truly show up. All right, this is the part of the waterfall that confuses people most. And honestly, it confused me for a while too. The catch-up. Here's the concept in simple English. The preferred return creates a period where the sponsor gets nothing. You as the investor, you're getting paid first. The sponsor, they're waiting. The catch-up basically means once you've made whole on your pref, the sponsor gets to catch up their share of the profits, and usually really fast. Now, let me tie some numbers to this. You invest $100,000. There's an 8% pref, and the sponsor owns 20% of the carry, therefore after. Over 5 years, you receive your 8%, roughly $40,000 in preferred return. The sponsor has received nothing during the whole period. Now the catch-up kicks in. In a full catch-up, which is common, 100% of the next distributions, all of them go to the sponsor. You get nothing as the investor during this period of time. That continues until the sponsor has caught up to what their 20% share would have been if there was never a pref at all. Then, and only then, does everything go back to normal, right? The true 80-10 split going forward. There's a window in a full catch-up where you, the investor, receives nothing, zero. Every dollar goes back to the sponsor to make them whole on their 20%. Now, compare that to a 50% catch-up. Same concept, but the sponsor only gets 50 cents on the dollar during that catch-up phase. You are still getting distributions as an investor. It's slower for them, but better for you. Most investors I talk to have no idea that this distinction exists. They see 8% pref, 80-20 split, and think they understand the deal in totality. They don't. The part they usually miss is the catch-up. If you're in a deal-by-deal waterfall and the sponsor is getting paid on early winners, there's an obvious question. What happens if the later deals underperform? That's where clawbacks kick in. And the name tells you everything you need to know. If the sponsor got paid more than they should have been because the overall fund did not perform as well as the early exits, they're supposed to give some of that money back. Supposed to. But here's the thing about clawbacks that nobody talks about on a pitch call, on a webinar. They're usually only triggered at the end of the fund's life, not in real time. So the sponsor may have had that money for 3, 5, 7, 10 years before there's any type of reconciliation. And even then, a clawback is only as good as a sponsor's ability to actually write the check. If they've already spent the carry or sent it to their partners, collecting it is not straightforward. Some GPs set aside a portion in escrow, most don't. And some clawbacks are calculated net of taxes, which means the sponsor only returns the after-tax amount, not the gross distribution. That's a big haircut. I always ask for the clawback, always. Not because I'm planning to use it. If I'm relying on a clawback, that deal has already gone sideways. But because of the way a sponsor answers that question, tells me everything I need to know about how they think about accountability. A sponsor who gets defensive when you ask about giving a clawback is information that you need to go take into consideration. Pay attention to it. Now, let me bring all this back together in one clear example, because I think this is where all of it really clicks. You invest $1 million. The deal runs at 5 years. At exit, total distributions are $1.6 million. Your capital back plus $600,000 in profits. Both deals have an 8% pref, 80-20 split, identical headline terms. Waterfall A, a 50% catch-up. Sponsor waits until you're whole. You get your $400,000 pref over those 5 years. Then your $1 million in capital comes back. The catch-up then runs at 50%, so you're still getting paid in that phase. By the time everything shakes out, you're walking away with a little over $1.5 million. Waterfall B, full catch-up, no clawback. Same $400,000 in pref, same $1 million in capital returned, but then the catch-up hits, $120,000. Go straight to the sponsor before you see another dollar. After the split, what's left is about $1,464,000. So same deal, same performance, but you made almost $50,000 less in that deal because of it. And that's one deal. In a fund with 10 investments, some winners and some losers, no clawback, that gap can compound in a big way. That's $48,000 that you gave away because you understand the waterfall. To put that in perspective, that could be a year of your kid's college tuition. That's a closing cost on the property. Not because the deal failed, the deal did exactly what it was supposed to do. You just understand how you're getting paid after your pref. The pitch deck shows you the headline. The operating agreement shows you the actual deal. They are not the same document at all. You need to review both. Here are 5 things I look at every time I'm reviewing a waterfall. Not in any order, they're all really important. 1, when does the sponsor start getting paid? Do they participate in profits in the whole period or only at an exit? And when they do participate, is it after I'm whole or while my capital is still at risk? This tells me more about alignment than anything else in the pitch deck itself. 2, what's the catch-up? Is it full? Is it partial? Is there none? If it's full, I want to understand the size of that window where I'm not getting paid. And I want to know if that's typical for this type of deal or if they're being aggressive. 3, is there a clawback and is it actually tangible? Not is there a clawback provision in the legal docs? That's easy. I want to know, is there an escrow? Is it net of taxes? What actually would trigger it? A clawback that exists on paper but can't be collected is just nice to have in writing. There's no value there. 4, how much of their own money is in this deal? The GP commitment, if someone's asking me for $1 million and they've put in 50,000 into that project themselves, we're not aligned. I don't care what the waterfall says. Skin in the game is a meaningful thing that drives behavior. I like to see anywhere between 2 and 5% of the fund, depending on the sponsor themselves, right? Relative to their net worth, it has to be meaningful. Not necessarily about the number. It has to be like, would this be meaningful to them if they lost it? 5, where do the fees sit? Are management fees coming out before returns are calculated, or do they come in after? Because if fees come out first, the 8% preferred return is only 8%. The effective hurdle then is lower than you think. And my goal here isn't to be difficult, right? I ask the questions because sponsors answer them well, clearly, without getting defensive, tend to be the ones who've actually thought about alignment. And those people are the ones I want to invest alongside. A waterfall is not complicated. Pref, return of capital, catch up, split. You can learn the mechanics in 10 minutes. But the variations inside that structure, how the catch up works, whether there's a real clawback, how the waterfall differs between real estate, private equity, credit, these are the details that separate a deal from being truly aligned with you from one that just looks like it. In private markets, incentives are the only thing you can trust. And the waterfall is where incentives actually live. If you take one thing from this video, let it be this. Don't sign until you've actually read and truly understand the waterfall. Not the summary, not the pitch deck, the actual waterfall of where money goes in and how capital flows. Over the last 3 videos, we built a great foundation. How capital works, how priority works, and now how the full structure in waterfall works. Next, we're going to talk about how money actually flows into a deal, the entire capital stack, capital or calls, because the way you fund an investment matters almost as much as the way you get paid. I'll see you there.